I'm not sure if I would say commodities will outperform equities massively, because this is of this shock on the longer term. I certainly do think that this never-ending ratio that is going down, that can be stopped, of course. So that would be my idea. So I think commodities will be fine, but I do not necessarily think they are fine, better off than equities.
Welcome to the Gold Republic podcast. My name is Bart Brands.
And I'm Alexei Jordanov. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments.
In the first part of this conversation with Jeroen Blokland, we've addressed the global financial reshuffling and how economic warfare impacts different asset classes, the energy crisis, and many other things. In the second part of this conversation with Jeroen, we'll address how these volatile times impact your assets, how you should allocate them best, and understand the different volatility across different asset classes. We obviously also ask him about commodities, because we've seen commodities rise and spike and surge in the recent times. Will it last? Are we in a commodity supercycle? We obviously also ask him about gold. How does gold fit in the optimal allocation of assets? And why did Jeroen change his mind about it? So, enjoy this conversation and let us know what you think in the comments down below.
Talking about assets, we've seen extreme volatility in the market, and we've seen commodities performing amazing. Is this the... Are we starting where are we in this commodity super cycle? Are we starting it? Is this the super cycle? Because we see that people are turning into value investments where they see, their money is more risk covered.
Yeah. So this whole concept of the super cycle, I like it, but how do you pinpoint where you are? So a couple of things from both sides. So again, of course, the energy complex is the best example. So there are areas in which supply and demand are quickly out of whack. So that is one. What is also, I think, very underappreciated is that, again, this whole drive to sustainable societies is extremely commodity intensive. If you want to buy a Tesla or a lot of investors, I think, believe that that sustainability comes out of thin air, but it takes a lot of resources and commodities. So that is a driving force. At the same time, we should acknowledge that time and time again, when it comes to commodities, if the price is high enough, two things will happen. First, it will kill off demand. So, of course, this is more difficult for commodities that we use on a daily basis than for other, but we will start to use alternatives. We will start less. We will push forward investment that we are thinking of. That is one. That is not immediately, but that is something that can happen pretty quickly. The second part is, of course, that higher prices also forces higher supply, because everybody wants to make a big buck by being a commodity producer. Now, of course, that is not as easy as I say it, but so higher prices will trigger supply. And I think what you have seen now, who is talking about we should close coal? We even in the Netherlands, we have this natural gas issue. Should we have it, but we cannot take it. You see a lot of countries, they say, okay, this sustainability angle for now is less acute than what is happening now. So some of these resources are actually available. We just didn't want to touch them, and that is the option that governments have. Do you want to do it now? And my guess is that it will go like this. We allow it for a couple of years to reopen these fossil fuels supplies, or we can extract them, while at the same time emphasizing more sustainability investments. And that is already what you see in Europe This is the narrative. This is the narrative now. Okay, we need it now, so we allow it, but only if we can compensate that in the future for less. And I think if you allow that, then it means that supply can also go up. It's not just so you can get a situation that demand goes down and supply goes up. So my guess is that there will, in the next, that's 12 months, there can also very reasonably be a period when commodity prices come down hard before they resume their long-term trend from the underlying the demand for sustainability and housing. We need more houses and things like that. That commodity prices in the end will be higher than we have seen over the last 5 or 6 years. Yes, but that was the exception, not before. They were extremely low. So yeah, super cycle, I don't know. I do think it has become a much more interesting asset class because of these drivers. Because before it was always lower. Then we're going to phase out oil, lower. And that has changed. So I do think it's an attractive, especially now. So we are overweight when you talk about asset allocation. But I can imagine that once this combination of demand destruction and supply finds or combines, that you then get a big drawdown in commodity prices before it goes up again.
So the best cure for high prices is high prices.
always, because that is the only thing. Prices are high because there is too much demand for supply. Now, there's only one way to do that, to change that demand to supply. Most of the time, supply is not that flexible. With fossil fuels, it's more flexible than we think because it's there, but we said we don't want to use it anymore.
So we can say that we are living right now in very volatile times, and the markets also reflect this volatility, right? Mm-hmm. You've just mentioned that the DAX 8%, bam, like Bitcoin as well goes up like 10%, stays there for a day, and then bam, going down 10%. Gold has been just like one way up. I mean, like just one straight huge weekly candle, just like blowing through which for gold is highly unusual, which of course the current event triggered even more. So how do you navigate in those volatile times? What are your frameworks? What are the metrics that you use? How do you approach that in general?
Yeah, so the first lesson, I think, and you have to experience that a couple of times, is that I think a lot of investors, they feel the urge to do something, because either it goes completely wrong or everything will become much better. And that is, you don't have to do that. So the thing is, you can tweak your portfolio alongside your changing odds that something really, really bad happens. Because it will never be a 99% likelihood, because if you have, then you can, most likely you have other questions or you have other problems, right? So what we do in our frameworks is try, and that is the same in these volatile times, only it's more difficult, is to find these macroeconomic indicators that tell you something about future performance of asset classes. So risky assets are down, but some are more down than others. So an example, we look at spread levels and drawdowns in equity markets and the yield curve to estimate a recession probability, because we have been talking a lot about recession. Now you can see at one point, a couple of days, I put it in one of our daily insights, equity prices or equity markets were pricing in roughly 40%. Based on their historical drawdown surrounding a recession, 40% chance of recession, spread zero, because they are still below the long-term average in non-recessionary periods. But they have to be higher if there's... and then you have the yield curve that's very flat, and that is also pricing a decent, so roughly 20% recession. Now, so this is something, if you don't want to make changes, then this is one of the examples. Okay, you know that from this angle, if you think a recession is the biggest risk coming out of this war, now then you can say, I want to lower my risk profile. Now, my idea would then do this by selling high yield and credits, because spreads are not reflecting any recession odds, and the S&P 500 is. So if it does not materialize, you are wrong, very wrong with equities. and less so than spreads. And then, of course, spreads, high yield has a lower volatility. So but you can calculate how you should scale that into your portfolio. But that is an example. So sitting tight and doing nothing is a good starting point. But yeah, please allow yourself to move a little bit as you think that the odds are changing, and this is difficult. But what you at least always can do is say, okay, suppose I believe in this scenario, which asset class reflects this scenario the best? And also, if I'm wrong, which should I? So that this is why we are at the moment not underweight equities, but underweight high yield, emerging market debt, and corporates, because there is virtually no risk priced in, or much less than in equity markets. And this is also why I think this is the time where volatility is high, that you get a day that the DAX index does 8%. For me, that is very difficult. I don't want to. It's almost like betting then, because So that is. We can talk about models all we want, but this is just one example. I try to gather. And that's not also about macroeconomic data, but also sentiment data. How are investors positioned? How is their momentum? How do they look at the markets? And then, of course, you have valuation. And all of these metrics, they continuously, if volatility is 30 or 10, they give signals. Now, the thing with volatility 30 is that it is much more blurred, and the odds that they are wrong is much higher, but they still do the same thing. And what I do with True Insights is we made a framework of all relevant measures, and it spits out this points to equities, this points to risk off, this points to within equities value or growth, this the euro dollar. So I think you should sell the euro dollar because of this monetary policy divergence. And then you add this up, and this is a fundamental, this is not mechanically, but you add this up, and then you hope that this framework on 60% of the occasions let you take a good decision, and then on average, you beat the market a little bit, but you should not be surprised if you also get it 40% of the time. It's not the correct decision that you take. That is my business. So this is the way I want to help investors make better investment decisions by providing them the tools, the means, the indicators, and then I have this conclusion. So based on what we are seeing, all these indicators together, perhaps not underweight equities, but perhaps if you want to risk off, do it through high yield or any other asset class.
Before we started this recording this podcast, we were having a little conversation about gold, because this is the Gold Republic podcast.
Yes.
I would really like to hear your opinion on what you think gold could or should mean in highly diversified portfolio.
Well, so as a diversifier, it's perfect, right? So if you want to add diversification benefit, as I call it, then gold is a candidate, and you can do that through buying commodities, which also has a big chunk in precious metals, and of course gold. Or you can buy gold separately. That is one thing. The second thing is I think there's value in this, and the seizing of central bank reserves, Russian central bank reserves, underpins this notion of idea that I have, that there lies value in wanting to protect against massive inflation, fiat debasement. You can make it as dangerous as you want. I'm not really, but I can imagine that you want to have some part of your portfolio of which you think that can protect you against these kinds of things. And gold is one of the it has the longest history. It's well known, and so from that sense, I think it's a good idea to either consider it or add it. So this is also where I am in my portfolios. We have it through commodities, but I'm thinking about adding it as a separate asset class because it also behaves different than industrial metals and oil, for example. So that is one thing. This is also the same reason why I think that people who believe there is this kind of insurance policy against these things should at least also consider, they do not have to invest in things like Bitcoin. So crypto is maybe a little bit different than Bitcoin, but because Bitcoin also moves in that space. Let me put it this way. Yeah? But there are also other things, farmland. You can name, but in that part of your portfolio, which I think the percentage weight should not be zero. Gold is at least the most well-known and most respected. And again, this drawdown, it has done what you would have expected, whereas U.S. Treasuries, also seen as a haven asset, have not done what you would have expected because of this inflation threat. Yields have gone up and their returns are negative, whereas of gold is positive.
Even the adjusted for inflation treasury?
That is also, it still has duration, so it's still down. But of course, the gap with nominal bond yield is much bigger. And so inflation. This is also what we played in our portfolio: long inflation-linked bonds, and until recently short treasuries. By now, I think that bond yields don't go up that much because of this slowdown. But the thing is that you don't get these kind of occasions to test if your safe haven assets really are haven assets. Now, and I think that gold has come out again as perhaps the best one, but at least it did what it had to do. It went up when everything else went down.
On that also note, Bitcoin is seen as the digital gold, and because of the fact that it's seen as from the nature of decentralization, that it cannot be seized and is not controlled by any central government, bank, or any central entity, has also that nature of that neutrality that gold is and had for the last 5,000 years. Yet it's also put into the more risky asset class, maybe because of it's so young, it's untested, it's only been there for 10, 12 years, it's fully digital as well. How would you then define Bitcoin as an asset class? Is it first an asset class? Is it a risky asset class? Was it part of the diversification that we're talking about?
Yeah.
How is it correlated to stocks? And how does that correlation actually evolve over time, and especially now recently in the last weeks?
Yeah, there's a lot of questions, but yeah. So first of all, to me, Bitcoin is an asset class because especially as you mentioned, when you are judging an asset class, you look at risk and return, but also risk and return relative to other asset classes. And the only thing, but an important thing is, does it behave differently because of its own characteristics? You have to believe in that. So does Bitcoin has its own characteristics, its own fundamentals? A lot of people doubt that. And then you can measure that in terms of correlation and things like that. But first of all, fundamentally, could you consider it digital gold? That is, I think a lot of people think it's even more than that, and a lot of people think it's less than that. But in this whole, the value of this insurance premium against inflation, debasement, and things like that, it fits there. If you want to invest in that, is a second thing. I think you should, but so it is an asset class. But then you come to some of the specifics that you have already mentioned. First of all, it's very small. So it's almost 4 times smaller than the next asset class. So inflation-linked bonds are also a small asset class, but they are 4 times bigger. It's 4 times bigger than Bitcoin. So it's very small, and that means also that if the whole world wants to allocate 5% of its portfolio to Bitcoin, we're going to have a problem, and that can only be solved again by higher prices. So that's one thing, and that is on the upside then. But there's also the volatility. So if you look at correlation, yes, it is a risky asset. 2 things about that. A lot of time people start to talk about the correlation of Bitcoin when markets are dropping like a stone, and every correlation goes to 1. High yield, commodities most of the time, every risky asset will do the same, right?
Is there some that do less or like are dropping less, or they're all going bottom?
No, the magnitude can change. So correlation is not about how much do you fall. It's are we moving in the same direction? So equities can do -5% and high yield does -2%. But still the correlation could be 1 theoretically. And most of the time when the stress rises, Bitcoin also becomes a risky asset. The thing is that if you look at, and that is why I mentioned high yield debt, the correlation between high yield and the S&P 500, for example, I looked at that, goes to 0.8. 0.8 is stress situations, and I've defined a couple of stress situations, 0.8. With Bitcoin, it goes to 0.5, 0.6. That still means that from a diversification angle, Bitcoin offers more benefit. That does not mean that you will have a better return, because that goes -10, equities -5, Bitcoin -10, high yield -2. But in terms of diversification, it still adds more value than other risky assets. That is one thing. In more normal times, less stressy times, the correlation is also lower. So it's not as low as when we started, but it's still, from a risky asset perspective, it's very low. And what a lot of people forget is you don't measure when you're a multi-asset investor, and you should, then you have to measure correlation against all asset classes, not just against the risky ones. And then you see that the correlation of Bitcoin is attractive. The thing, of course, is that when you have an asset class that does its own thing, that all the volatility it has, you also get it on board. You cannot diversify that away. So that is why I don't think that if you believe in risk and return and diversification, you can invest for 80% into Bitcoin. Because then this whole Bitcoin thing takes over, right? And I think that there's where you if you have a high risk tolerance, you can add more of crypto than people who have a less tolerance or are closer to the point that they actually need to get the money out. But this is a big consideration. It has significant diversification benefits. Hence, it also comes with a high volatility that you get. You cannot diversify it away that easily. That is the whole thing I try to do with Bitcoin. You want to invest in it? Okay, but do it in such a way that it does not dominate the rest of your portfolio. One thing on gold, by the way, a lot of people also think that gold is riskless, but it has a volatility that is equal to equities. But also it has a low diversification. But in terms of volatility, it's not that low. And that is the final thing. A lot of, again, investors, they believe that safe haven assets or inflation protected assets, that they have a inflation-like return with even lower cash-like volatility. But that is not the case. And that is also why I think I told you about the high volatility of Bitcoin that you actually incorporate in your portfolio. But it is not necessarily a bad thing. The Bitcoin volatility is pretty extreme, but that something is volatile. Gold is also relatively volatile, and it is the haven asset of the world with a 5,000-year history. So something that offers protection does not mean it's not volatile or doesn't bring risks.
But relative, and it's relative to what, and which one of all asset classes is the lowest from a volatility perspective? Is it also because general markets are volatile, or how do you basically benchmark it?
Now, for me, is the volatility of the portfolio. So okay. If you add treasuries, which still have a lot of protecting account against downside risk, this is a good reason to add low volatility assets like treasuries. They can have a realized volatility of 4%. So that is really, really low. So there are still assets. Cash has a volatility of almost 0. So you can lower your volatility. So in that sense, before Bitcoin, we were used about a spectrum of return about 2 to 8%, and a volatility of about 4 to, let's say, 20% emerging markets or commodities, for example. That was the universe that we were used to. And now we have this new asset class, and that has a return of minus to very high, but also the volatility very high. And the idea behind it is to find a way to incorporate that into your existing portfolio in the right way, so that it does not distort your long-term objective. And that is possible. And that's also why I don't really understand all this people on the one side that there's only Bitcoin or there can be no Bitcoin. I don't understand.
Yeah, and if you say incorporate it into your portfolio without distorting the rest of your portfolio, it means add a really small amount, right?
Now, that depends on your risk tolerance and how long you want to invest. Of course, as I mentioned the example of 80% Bitcoin, then all the rest doesn't really matter. But I do think that for some people, you can have a significant allocation towards gold or Bitcoin or both. But I always think that equities and bonds, they are the core of your portfolio. In that sense, yes. But I can imagine that people will, add a weight to that is higher than 0.5 or 1%, because you can do a little bit of math on there. If your risk tolerance is equal that of equities, and a balanced portfolio of all the traditional asset classes has a volatility that is half of equities, you can add 8% of volatility. You can allocate towards riskier assets like gold or Bitcoin. And so it's not that you can go quite far and still have, because young people will have an allocation of 100% equities. So they can work with this volatility budget of equities. And if you then say, okay, I want to subtract a little bit from the weight of equities and put that in something else, you have room to work with. And so it doesn't have to be that small, but of course it cannot be 50 or 80%. Yeah, it can, but then it's not diversifying anymore.
There's also what we've seen now in general. You have stocks also. I mean, they're decreasing now in the last Q1 in general. Commodities are picking up compared to equities. We've seen that there's I think Tavi Costa, he was also in the podcast. He just called it the great unwind. I thought it was a good term. And a big shift from tech to natural resources, as we are in this current context, right? Like of uncertainty. And is this short-term lift trend, or can this have legs for a more longer-term, medium-term stretch where we see basically that ratio from stocks compared to commodities pick up?
Well, first of all, I'm not that negative about equities, right? So on overall, the return will be lower than in the past because bond yields are lower, and hence the risk premium, even if it's still the same, your total return will be lower. And so that is not that strange or different. Also, a lot of focus is on US equities, which are still pretty expensive. But if you look outside the US, valuations are now actually below the 10-year average. So after the recent drawdown, so that they are also not extremely expensive anymore. So given that they will create earnings and pay some of these earnings out to you as a stockholder in the form of dividends, I think commodities first have to compensate that, and they don't generate any income. So that is the first step. So they already need a 4%, 3%, whatever region you want to take, income or return, and then they start competing with equities. Having said that, as mentioned before, I do see that there is a longer term, or let's say there is a secular demand for commodities coming from sustainability, from the houses that we need, whatever, that it certainly will be a better period for commodities than in the last 10 years, because most of these charts, they focus on the last 10, 15 years, and then you see equities were perfect and outperformed everything else, and then commodities were the laggards. So if you put this in a ratio, that looks pretty steep, and I do think that this doesn't have to be the case. I don't know if it will go horizontal or if it will go up again. Because even if equities realize a 7% return, for example, if commodities would do that as well, that is pretty decent, right? So also for something that does not give you any income on the outset. So I'm not sure if I would say commodities will outperform equities massively, because this is of this shock on the longer term. I certainly do think that this never-ending ratio that is going down, that can be stopped, of course. So that would be my idea. So I think commodities will be fine, but I do not necessarily think they are fine, better off than equities.
But in case of scenario of a recession, equities tend to not perform that well, isn't it?
Yeah. Then it's easy. Easy. But then again, you get to equities are the most risky assets, and with earnings, you are at the end of the line. So when the earnings dry up, you get nothing. So for a short term, then they underperform everything. But then, as the economy gets out of the recession, and do not forget, for the last 10 or 15 years, helped by central banks, liquidity, which is much easier to put into equities than on commodities, which are much more dependent on this demand and supply dynamics of that point in time. So yes, then they will do that. But already, if we get a recession, let's say this year, already 10% of the drawdown that equities show in the run-up to a recession is about 25%. We already had a big chunk. And if then commodities demand cools down, but yes, for a brief period, commodities will outperform. I do not rule out that they can remain outperforming, but then you have to be a strong believer in this super cycle. And I'm just not there yet because of these many outside shocks that we are seeing now.
It's also a decade-long process, a super cycle in general.
Yeah.
We've seen it beginning of the 2000s.
Yeah.
Okay, because I was curious, because you kind of discovered gold as multi-asset investor.
Yeah.
It's getting late.
Yes.
But we haven't talked about how you're allocating in gold. Is it ETFs? And you come from the paper world, and we've talked about this before, you, Bart, especially.
Yeah.
We are precious metal, a physical it's physical billion allocation.
Yeah.
And there's a fundamental difference, right? And we also pointed out, especially Bart, when you talk to customers, where do you see the difference and maybe the change of behavior or your perspective on the way you invest in gold?
First of all, so if I invest in gold, I want it to do what the price of gold does on a market or physical. That is the first thing, and then the instrument. I think most of the time the first idea is to have a paper, as you mentioned, a paper instrument. But this is also what we talked about. I do believe and I do think that an investment in gold has this insurance aspect attached to it. And from that angle, and that's also why I find it fascinating, and I'm certainly no expert on that, and you are, I can imagine at some point that you say, okay, I have to choose, why not do it physically? Why not have it physically? So the whole narrative around this, I can understand. Of course, I would have a couple of questions that if I don't then want to do tactical asset allocation, and I can do that in my online broker account with a couple of clicks, how do I do that? And that is also how efficient is it in changing? Now I can imagine again that because of this whole insurance thing, that gold is not something that you go in and out of. So that also reduces this question, but that is a question that I would have. How can I steer it over time, and can I, especially when things like this happen, and I want to have a more a low profile, low risk portfolio. But yeah, I do find it interesting. But yeah, this is also why I'm here. Of course, that we can exchange interesting ideas. I can imagine that people say, "Let me do the tangible thing." Then
let's conclude. You have, as we mentioned in the beginning, and also throughout the conversation, you've started the company True Insights. Maybe you want to say a few words about what you're doing and how our listeners and viewers can also benefit from it.
Yeah, so my company True Insights writes stories about markets which investors can use to navigate those markets. So next to that, we provide portfolios on, okay, I know that diversification exists. I know that there are diversification benefits, but yeah, how do you start? How much equities? How much bonds? How much commodities? How much gold? How much Bitcoin? And we combine these two things. So first of all, you can construct yourself a well-diversified portfolio. You don't have to worry that these diversification benefits are there. That is the job that we already have done. But then, of course, no market goes up in a straight line. And we try to profit from that whenever we see chances. And that is also what we talked about. There's where the framework comes in. By using this consistent framework surrounding macro indicators, sentiment indicators, and valuation indicators, we try to have a consistent and structural way of judging on where markets are going. And that is what our research does to let you profit from that information and to anticipate or react to market developments and changing circumstances. And that is basically what we do in a nutshell. And we have some other things coming, but I will talk about that. Or we're starting a blog, so I will talk that in the blog that we are going to expand the service a little to make it even more tangible. And my idea is that investors that want to do it themselves, but they need information on how to do it, that they come to my website and become a member.
Mm-hmm. And what website is that, and how can people reach you?
Yes, that is a True Insights with a dash .net. And also, if you want to contact me, I'm on LinkedIn, I'm on Twitter, and you can also send me an email, of course. That is jsblokland@trueinsights.net, and again a dash between True and Insights.
And you also, I've taken advantage of your 1 month free trial that anyone can, on a basic package, also try out True Insights.
Yeah, we offer a trial because most people want to see what they are buying, and I understand. So what we offer is that you can, for 30 days, for the essential membership, you can see what we are doing, and also that gives us, of course, the opportunity to show what we can do and how our investment research can help investors make better informed decisions. So people are more than welcome to have a look first, and it is my job to make them stay.
All right.
Is there anything you want to add and conclude this conversation with?
No. It is a long evening, and maybe we should now have a quick drink. And then until next time.
Yes. Thanks a lot, Jeroen. Appreciate it. Thanks for hosting us in your office.
Yeah. Thank you. Well, of course, to all the viewers and listeners, to all the viewers on YouTube, if you thought this was an amazing podcast, an amazing video again, please give it a like. If you want, please leave us a comment down below, and please, of course, if you haven't subscribed yet to the YouTube channel of Gold Republic, please subscribe. Alexei?
Yeah. If you're listening to us on any podcast platform, you can rate us. It also helps us to be more visible. If you find it also valuable to anyone else, please send it and spread the word. And until then,
we will see each other at the next episode of the Gold Republic podcast.